This video is over initial public offerings. I'm your professor, Dr. Stephen Haggard. So what is an IPO, or initial public offering? It's the first time a firm's stock has been made available for sale to the general investing public. Before then, the only shareholders would be the founders of the firm and any early investors such as venture capital firms. Other than that, it's really difficult to buy a portion of these private companies. And so why do people do an IPO? Because after all, when you sell shares to other people, it means now you've got more people getting a piece of the pie. And in general, though we try to teach our children to share, we know that humans don't really like to share. So why would you do it? Well, the first reason is usually stated as the company needs the funds for additional expansion. And there's usually some truth to that. Think about Amazon.com. Think about all the distribution centers that they built out over the years. There's no way that Jeff Bezos and the other initial founders of Amazon could have funded that build out with their own money. And so an IPO was very necessary for the growth of that firm. But secondly, these IPOs provide liquidity to the initial owners and early investors of the firm. These people have created a lot of wealth through their efforts at the firm, but they can't spend any of that wealth unless they can turn it into cash. An IPO is a way to turn it into cash to allow them to purchase Ferraris, mansions, and the other things that people do after they start a company and successfully sell it to someone else. Now, this leads to some issues though. Let's think about information asymmetry. The original owners and the venture capitalists and their investment bankers to some extent have more information about the prospects of the firm than the investing public. In fact, there are incentives for the insiders to try to sell the firm through an IPO when the public thinks that the firm has good growth prospects, but the managers know things are about to go badly. And so we've got this issue of information asymmetry. And one of the ways people attempt to overcome this information asymmetry is through the choice of an underwriter or investment bank. If you select the correct investment bank to do your IPO, you can send a strong signal that you are a good quality firm. And so the choice of an underwriter is quite important. So far, we have, in our study of IPOs, we've come across two very broad conclusions which have yet to be disproven. And the first is that IPOs, on average, are underpriced. What does underpriced mean? It means that the firm closes, the stock trading closes at a price higher than the issue price. And any money that happens between the issue price and the closing price for the day, that's money that the firm is said to have left on the table. And so logically, you would think that firms would want to leave as little money on the table as possible. Yet we consistently see this underpricing year after year after year. And so there's got to be something else going on here other than founders of firms trying to make Joe shareholder rich. And so that's what we spend a lot of time in the literature trying to explain. And the second big broad conclusion that we've reached is that firms underperform in the 3 years following their IPO. So if we start on day 2 of trading and go out 3 years, we looked at two identical firms, one that hadn't just gone public and the other one that did. The one that did go public would underperform the firm that had been already trading in the market for a while. And so this is what we would call an asset pricing anomaly, and it's difficult to explain. And over the years, people have argued back and forth over whether this underperformance actually exists, but the preponderance of the evidence says that it does. So what are the big questions about IPOs? We've already discussed IPO underpricing and the fact that we think that it exists, but the bigger question would be, why are IPOs underpriced? After all, This is the company leaving money on the table. And a couple of the papers we're going to talk about today have some ideas on why that might be. Secondly, we've already talked about firms underperforming after an IPO, but we can put these two things together and ask, is the magnitude of the underpricing of an IPO related to the magnitude of its underperformance post-IPO? In other words, are firms that are underpriced more, do they perform more poorly after the IPO? And if that's the case, then what we might think is that the problem is solely with that first day return, that the price simply ran up too high on the first day. That would be consistent with the high underpricing predicting bigger underperformance. Then we're on to asking, why do firms choose the underwriters that they do? The underwriter is the investment bank or banks that helps take the firm public. And firms have a wide choice of underwriters they could use, and some are more expensive than others. In fact, some are quite a bit more expensive than others, yet we continue to see firms choose those expensive, prestigious underwriters instead of going with a less famous investment bank and paying far less, or even attempting to sell the shares themselves. And that last piece isn't unheard of. The latest example that I saw in the Wall Street Journal was the telemarketing firm Ronco, those people who have those infomercials about rotisserie chicken cookers and such. They were actually attempting to sell their shares themselves online to the same people who were buying the rotisserie chicken cookers. And so you might be able to do an IPO without actually having an underwriter. So why in the world would you choose an expensive underwriter if you didn't absolutely necessarily need to do so? We have 3 papers that are of particular interest on this topic. The first is by Kevin Rock, and it is from the Journal of Financial Economics, and it has a very straightforward title, Why New Issues Are Underpriced. He's not asking a question, he's telling you that he has the answer. And what Rock does is basically break investors into 2 groups, theoretically, informed investors and uninformed investors. And then he posits that it's not enough to be able to raise money from informed investors, that in order to be able to successfully go public, you will also need to be able to attract uninformed investors. But uninformed investors are concerned about being ripped off. So in order to entice them, you have to offer a discount. And so that's why new issues are underpriced. Of course, Rock's story is more complex than that, but that's the crux of it. The next paper that we're going to look at is Carter and Monaster, and this was really the first paper to look at underwriter reputation. We just got through asking the question, why might you hire a more expensive underwriter? And Carter and Monaster posit that the reason you would do that is to signal what kind of quality of a firm that you are. Remember Rock's uninformed investors? If we can prove to them somehow that we're a good firm, they won't require as great an underpricing to buy our shares. Therefore, it might be worth paying an underwriter more if it would save us even more in the money that we have to leave on the table. And so this is a very good paper that gives us some measures that have been used by lots of other authors over the years to look at underwriter reputation and what are the implications of that. And then finally we have a paper by Jay Ritter. Jay Ritter is without argument the most cited author in the world of IPO. The man has dedicated his life to it. In fact, you can go to his personal website at the University of Florida, and he has data on all sorts of initial public offerings, and it's there freely available for you to look at. So I encourage you to go out there and try to take a look at that and see if you can find your own interesting things about what's going on with IPOs. So what does Jay Ritter tell us about in this paper? He talks about the long-run performance of IPOs and comes to the conclusion, using several different benchmarks, that IPOs underperform for about 3 years, of course this is on average, underperform for about 3 years following the IPO. And he links the initial underpricing to this long-run underperformance and posits the idea, throws out the idea that the linkage between these things is consistent with that first day price being ran up too high. He also talks a lot about the tendency of firms to issue during hot IPO periods and how people get caught up in these fads. For instance, actually this paper was written in 1991, long before the internet bubble. But then the internet bubble came along in the late 1990s, early 2000s, and we saw what Jay Ritter predicted to be carried out perfectly in front of us. These internet stocks were ran up too high on the first day of IPO and then underperformed afterwards because it was one of those hot IPO issue times, and the fad was internet stocks. Investors were systematically overestimating the future prospects of these firms and as a result running up their share prices too high.